Hi everyone. Today we're going to be working in Financial Accounting, Chapter 2, Measuring Business Transactions. And we're going to be focusing today on Learning Objectives 5 and 6. Learning Objective 5, we're going to look at the chart of accounts and then record some transactions in our general journal and post those transactions to the ledger. And then in Learning Objective 6, we're going to show how the timing of transactions affects cash flow and liquidity. So let's start with Learning Objective 5. In this objective, we're going to work with our chart of accounts and record some transactions. If you think back to earlier in the chapter, we described how transactions are analyzed according to the rules of double entry accounting, and that we will prepare a trial balance after our journal entries are posted. In this section, we're going to use manual accounting to focus and demonstrate steps 1 through 3 of the accounting cycle. And if you'll recall, step 1 of the accounting cycle is to analyze those transactions, determining the effects that each transaction has on assets, liabilities, and stockholders' equity. This is where we basically look at what accounts have increased and what accounts have decreased, and use that supporting documentation to determine that information. Second part of the accounting cycle is to actually record the entry in the journal. That's where we would apply the rules of double entry accounting, ensuring that there's at least one debit and one credit, and that the debits equal our credits, and that there's always at least 2 accounts that are affected by each transaction. And if you'll recall, each of our transactions are recorded in chronological order in our journal. Lastly, we will post the entry from the journal into the ledger, and the ledger is where we will maintain our ongoing balance for each type of transaction, for each type of account. So let's move forward here. So first of all, we have our chart of accounts. This is just simply a list of the numbers of accounts signed, the number of accounts assigned to a company. We'll have an account title, and we'll have a number associated with that account. And this way it makes it very simple for everyone to follow and know what accounts we're dealing with in our business. Typically speaking, our chart of accounts is scalable for the size of our business, meaning the smaller the business, the lower the types of numbers, the digits of the numbers we'll use. So smaller companies would use maybe 100s, 200s, 300s, 400s, 500s, whereas larger companies would use 10,000, 20,000, 30,000, so on and so forth. Our journal is where we will record our transactions in chronological order. Most businesses have one or more types of journals. As we mentioned earlier, there are special journals that businesses may use, but in the simplest form, there is the general journal that most businesses maintain. It's simple and flexible and easy for the business to use. So here we see a snapshot of the general journal. We see in this journal the column for the date, and we see that since this is page 1 of the journal, the date includes not only the month and the day, but the year. In addition, we see the description column where we have the debit and credit parts, of the transaction, the accounts that are debited and credited, and then we see the post-reference column, which is where we will place the reference to the account that this transaction, each part of the transaction is posted to, and then we see the debit amount and the credit amount. In the journals that are demonstrated in this particular text, we also will have an explanation of the transaction provided below each actual debit and credit in the journal. So that's just a quick snapshot of our journal. And here we have the chart of accounts for our business. And again, a chart of accounts is just simply a table of the contents of the accounts that are listed or going to be used in our ledger. Typically, it lists all the accounts in the order in which they appear in the ledger, which usually is the order that they appear in the financial statements. The numbering scheme allows for flexibility in adding new accounts. And in addition, we break this down into sections. So we would have our assets listed first. And typically our assets are reported in liquidity order, meaning most liquid would go at the top of the chart of accounts, and the least liquid or the most difficult to convert to cash would be listed towards the bottom. Then we have our liabilities in the 200 section. And again, our liabilities are going to go in the order in which they are expected to be repaid. And then below that, we have our stockholders' equity. Our stockholders' equity is typically listed with common stock first, and then retained earnings below that, and then any dividends or the income summary below that. And then lastly, we have our income statement accounts, including our revenues and our expenses. And our expenses, while in the last chapter we listed our expenses, our last textbook, our expenses were listed in alphabetical order. This textbook allows for some flexibility, and the expenses are listed in the order in which they would appear in the financial statements. Now, when we record our transactions in our journal, then we must post them. We must post them to the general ledger. And the general ledger is used to maintain an up-to-date balance of each account. The ledger account format contains 4 columns for dollar amounts, as we'll see in just a moment. And then the process of transferring information from the journal to the ledger is called posting. And here we see a copy of the ledger for the accounts payable account. And what we can note here is that there are several columns for the money columns out to the right, over on the right side of this ledger page. And at the top we see the accounts payable account title, and then over to the right we see the account number. Again, we see the date, the month and the year followed by the day. We don't have anything in the item column because we know, for instance, that this is the accounts payable account. Then we have the post reference to the general journal page that this transaction came from. So in this particular case, it's journal page 1. And then we see that the accounts payable has an increase of a credit for $5,200. And then we see another increase for $3,000, and then we see a decrease of $2,600. So the individual transactions are recorded in the debit and credit columns, and then the balance is recorded exclusively in the credit column as the account balance either increases or decreases for this particular account. Okay, so here we can see that posting from the general journal to the ledger, we have the snapshot of the journal page on the top part of this sheet, and then we have the ledger portions on the bottom part. So we can see in the general journal that we have a transaction where we received a bill from a company, a utility company, and we've journalized the debit to the utilities expense and the credit to the accounts payable because we have not yet paid that bill. So we're posting the journal entry for it, and we're posting it to the accounts payable and the utility expense accounts. And we can see that the transaction in the accounts payable on the 30th is post reference from General Journal page 2, And then we can see the dollar amount of $680 in the credit column. And then we can see the ongoing balance increase in the accounts payable account from $5,600 to $6,280 due to the increase of $680 for the transaction on July 30th. Then we go down to the utilities expense account, and we see that, again, this one is from July 30th. The post reference is General Journal, page 2. We're recording that debit of $680, and we're putting it in the balance column for $680. And then each of the account numbers is post-referenced back up in the General Journal to show that they were posted to the accounts payable account and the utilities expense account. Now, just one last thing to note, again, in the ledger, the balances are going to be maintained in the normal balance side column for the account that is being updated. Now, if we look over here, when we're recording and posting transactions, here are some formatting guidelines that we can, look to in terms of formatting the information. So, first, a ruled line appears in financial reports before each subtotal and total to indicate that the amounts above that line are added or subtracted, and it is typically common practice to use a double line under a final total to show that it has been verified. As we can see here from the financial highlights for McDonald's Corporation, we can see the account titles listed on the left and the information for the 2008 and 2009 fiscal years. The only thing that I would note here is that this is probably a typo from the slide, that underneath where it says prepaid expenses, that should be a single rule and not a double rule. So just want to note that there. It should be a single rule, just like the line below other assets, where that is a single rule. The only double rules on this page should be at the bottom under total assets for each of 2008 and 2009 fiscal years. As it relates to dollar signs are required in all financial statements and in the trial balance. The dollar signs are typically placed before the first amount and also wherever there is a totaling or subtotaling. Typically speaking, if we're using column ruled accounts, dollar signs are not used in the general journals and general ledgers. In addition, on normal unruled paper, commas, decimal points, etc. are used when recording dollar amounts. However, when we're using ruled paper, typically speaking, we do not use commas or decimal points on ruled paper. And then lastly, account names are capitalized when they are referenced in journals or ledgers or on the financial statements. Typically in the financial statements, though, only the first word of an account name is capitalized. So let's do a little stop and apply here, and again, you will receive a Google document to provide the answers to these questions. But essentially here what we're going to do is we're going to prepare journal entries for the transactions on June 4th and June 8th. And you can just provide that information, but you can write it right here to get yourself going and started. Okay, let's move on to objective number 6, cash flows and the timing of transactions. So we want to be able to show how the timing of transactions can affect the cash flow and liquidity of a company at any given point in time. So, cash flows and timing of transactions. To avoid financial distress, a company must manage its cash flow. It must also pay its bills on time. It's important to understand that the difference between transactions that actually generate cash and those that do not. Okay? So let's look at some common types of transactions. We see here an example of transactions for creative design. These transactions are also listed on page 112, 113 in your textbook. And you can look on the exhibit on page 113 and also on the next slide. The exhibit will be demonstrated. And basically what it will show is that Creative Designs, their cash account actually has more transactions flowing through it than any of the other accounts. However, it's the timing of the cash flows, the ins and out of the cash, that is the most important thing for the company to manage to ensure that it maintains its liquidity and pays its bills in a timely fashion. So we need to make sure that there is enough cash in the cash account to pay a bill when a bill comes due. So here's an example of all of those transactions listed on the previous slide and how they impact the inflows and outflows of cash for Creative Designs. So what we can see here is that we start out this month with the transaction going into the cash account on July 3rd. We see that, going out of the cash account on July 3rd for $3,200. And we see that the transaction was that Creative Designs prepaid rent of $3,200. So they basically paid out cash of $3,200 and it moved into the prepaid rent account. And we see that the asset for prepaid rent went up by $3,200. So that's a cash outflow. We have to assume that at this point in time, they had a cash balance that was sufficient prior to July 3rd to actually pay that cash out. Otherwise, they couldn't have actually, done that. So second transaction was on July 5th, and the firm received an invoice from an office supply company in the amount of $5,200, and they deferred that payment. And the reason that we say that they deferred that payment is because they actually received it, but they didn't actually pay it. So what we can say is that we are going to debit our office supplies for $5,200, but we are then going down to our accounts payable and we are crediting the accounts payable for $5,200. As you can see, at this point in time, there is no cash effect of this particular transaction. It does not impact the cash account at this point in time. Okay, then we move down to our transaction on July 9th. The firm paid $2,600, but continued to defer the remaining $2,600, and they'll pay that at a later date. So we can see that on July 9th, they paid out of the cash account $2,600, and that was a credit to their cash account, so the cash is going out. And then we see a debit in the accounts payable account for $2,600, reducing the balance of the accounts payable account. And then on July 10th, Creative Designs received a cash payment of $2,800. So we see that they received that $2,800, and it looks as if on July 10th that was a sale because they credit their design revenues for $2,800 and they debit their cash for $2,800. On July 15th, the firm billed a customer for $9,600 for a service it had already performed. So again, we see on July 15th that they recorded a sale in design revenues for $9,600, but they did not receive the cash yet. So they recorded an account receivable for $9,600. On July 22nd, the firm received a partial payment of $5,000 from the customer, but it still had a remaining balance of $4,600 at the end of the month. So we see that their accounts receivable went down by $5,000, but their cash increased by a debit to their cash account of $5,000. So the important thing to take note of here is that the company must pay careful attention to its cash flows and liquidity to ensure that it receives payments for services performed in a timely fashion in order to pay for services and supplies that it must purchase. So now what you're going to do is you're going to look at this company in the stop and apply, and the company engaged in the following transactions in the month of October, from October 1st through October 6th. And you're going to enter the correct titles on the T accounts on the next slide, and enter the above transactions in the T accounts, and then determine which of the cash balances are, when the cash balances are affected by these transactions, and the amounts that still need to be paid. So you'll see these T accounts here, and then you're going to do the cash balance after the transactions and the amounts still to be received after the transactions, and the amounts still to be paid after the transactions. And we will go over this in class. I will, again, send you a Google document for this particular problem. Thank you. And that concludes the notes for Chapter 2 of Measuring Business Transactions.